Mhm. Good. Oh, we're filling up well here. But we're not filling up with Walter. Where's Walter? Hey, Daniel, how are you?
Hey, John. Good.
Good. There he is.
Hey,
Nice.
John, how are you today?
I'm great. How are you? You had me a little panicked. I thought I was going to be doing an impromptu presentation.
No. I was there. Okay.
Good. All right. Sorry. This is a big waiting room. Apparently, it's taking a lot to fill it all out.
Oh yeah, that's awesome today.
I love it.
Yeah.
One
Oh
of
my
the
goodness,
one of
I see some familiar faces.
one of the things that Walter always comments on with our webinars and our customer base compared to the rest of the industry is how young you all are.
Yeah.
Ricky Kane, you and I are included in that crowd. So just think what an honor that is. Awesome. All right. Well, let's get started if we don't have anything to talk about ahead of time. I want to introduce Walter quickly. Most of you know Walter, either personally or through these webinars. We're going to talk today about topics related to dealing with debt and the idea here is if you have a windfall. We often talk with people who would like to make significant reductions to debt. Sometimes that is because you know receive maybe more money than you were expecting, or something happens so that you have excess money, if you will, to pay debt. I find repeatedly that there are a lot of real misconceptions about how to approach debt and debt reduction, and so that's what we're going to talk about today. So, thank you all for coming, and Walter, let's get ready to rock and roll here. That sounds good.
Yeah. Well, thank you, John. It's always I just always am blessed to see the youth in this group because you're the ones that we're passing the torch to, and you're going to make a difference in the world. So, anyway, what I wanted to, I guess, get us to think about on windfalls. Would anybody like to maybe share share a windfall that they might be thinking about, or I mean, I have some that I'm thinking about, but I would kind of like to see what our group is thinking about today.
So wish I could share a windfall story with you, Walter, but I haven't had that happen to me.
Oh, Jordan,
They strike oil on your place.
Yeah, yeah.
You have you have an uncle in Africa who's come into a great deal of money. A crown prince from an African nation contacts you to sure you're
right.
included.
Not when
You get a disaster payment, a COVID payment, for example.
Yep. It's not when a tornado knocks over a wind generator,
Oh, there you go. And then
like a
they
windfall.
Yeah, I have one that was kind of like that. Sometimes we have this discussion about CAFOs.
yeah,
Well,
confined animal feeding operations for anybody that
oh my goodness, John, did you go to Utah State?
I did, in fact, with
Okay,
Dr. Fred Provenza.
yeah, all right. Well, this was a few years back, and the windfall in that particular situation was it was the damage that came about from a tornado that scattered the hog buildings all over a couple hundred acres. And this particular farmer, and I mean, it's not too far from where I live here in Springfield, Illinois, but this particular farmer, he was looking to exit that particular enterprise anyway. Okay. And so that was somewhat of a windfall. Actually, on that particular situation or that particular storm, it actually took a harvestor, the donut that it sits on, out of the ground.
Ooh,
Yeah. Oh no, I know. So anyway, it was quite
that was a
a
real storm.
That was a real storm. Another one that I think that some of you may be thinking about or hearing, having information about. Oh yeah, a life insurance payment from the death of a family. That's a good one, Calvin. Yeah, life insurance proceeds. I mean, we had the, your long lost uncle, Ricky, leaves Gordon, Jordan something. Okay. Another one I think that's out there that we see in ag is the conservation easements would be another one. Okay.
I assume that's Catherine and Bruce. Is that who submitted that one? That's good. Yep.
Yeah. So, but anyway, let's see what else we got here. Yeah. So, yeah, but that's, because I mean, that's something that, that it's out there and you know, what are we going to do with those proceeds? I mean, sometimes they're being used for, to maybe enhance transition. Maybe we need it for, structure changes in our business. So anyway, we've got a few out there. So what I wanted to do, I wanted to go through, um, let's say that I've got an example on Excel today that I want to go through, and what I want us to think about is, um, we've got a year-end financial that, the Ranch Right team has completed, and we know that something's coming down the road in the upcoming year, and so it's a planning scenario that I want us to go through. Does that sound okay, John?
Sounds great. Are you sharing your screen?
I will when
Okay.
yeah, hold on a second. I will
Okay.
share the screen.
Good. I want to add one to our list. And yeah, Jared Lyman mentioned PRF insurance payouts. Those can be pretty big. The other one is you could just be very profitable and in a particularly profitable year generate a lot of excess cash. So let's never leave that one out.
Right. Okay. Is this can everybody see my screen, John?
Yep, I can.
Okay, that's good. Hold on a second here. Oh, how come I can't minimize your it's not letting me go to speaker view. Zoom is being squirrely today, John.
You know, I'm a big fan of Zoom. I only use it because of you.
There we go. All right, good. Okay. Thank you. All right. Okay. So, I know that I hope this doesn't seem, I mean, there's lots of numbers on here, but let me go through the scenario that I've put together here. I've got a summarized balance sheet with, about 750 in current assets, 1,250,000 in other assets, some current liabilities of 400,000, long-term liabilities of 1,000,001, and equity of 500,000. Okay, so this particular operation is somewhat high on debt to assets. I mean, they're pushing, if you look at the beginning of the year and the end of the year, they're pushing 75%. Now, John, do you have any feedback about it being that high?
That just puts us at risk. This definitely can work, but boy, you enjoy a lot of risk when you're in that position.
That's exactly right. So, I mean, there's only 24% equity in this particular equated asset in this particular scenario. Uh, they've got some favorable long-term rates out there on the long-term debt. They're 5.5. It's on a 10% deal, and but there's a debt coverage of only It's 17%. So is that, would that be, something that, we need to address? Does anybody have any thoughts on that?
DSCR. So is debt coverage the same thing as DSCR?
Yeah.
Debt service coverage ratio is that,
That's
yeah,
correct.
correct.
Yeah.
Typically,
right.
I mean, most people want to see 1.25, right? Most banks.
We want to see 1.5 to 2, but yeah, you can get the FSA, I think, is 1.2, correct, Walter?
Right. Yeah, that's correct. So this is a challenge. Okay. They've only have about $350,000 worth of working capital. And when you look at the activity that happened this particular year, their working capital went backwards, in the process. So it went backwards, $146,000 roughly. So, but if you go on down through some of the ratios here, just for sake of argument, I mean, this is the profit and loss. They actually had a $59,000 loss on a gross product of $1,000,001. So, um, um, I mean, this is one just for I'm laying out the scenario. But so I've got the beginning of the year
And that,
and
hang on, that loss does not include debt service, correct?
yeah, it does.
Okay, so that's a cash loss total.
That's that's just that's the loss with just, I mean,
'Cause
the
you've got-
interest is the
you've got
interest is in there.
You've got interest, but you don't have principal in there, do you?
We don't put that in the income statement.
I understand that, but they would have a $59,000 loss and they have to make a payment after that, correct?
Well, yeah, because what you really see here is that, I mean, here's the $59,000 loss, okay, and then, I mean, what really, I mean, they're making an $85,000 principal payment that they're doing out of in the process. So they had the 59 plus the $85,000 principal payment. Because see, the debt service is actually 145,000 on the term debt, and
So
there's
they earned negative 59 and had to pay you've already got the interest in there, so the
I've got the interest in there.
principal would be 85,000 in addition to the negative 59.
Right, correct. Got it.
Hard bill to pay.
You got it. Okay. So I mean, what's happening here is you've got the, I mean, you've got the 84,500, which is um $24,000 in a line of credit interest and 60,500 in interest on the $1,000,001. Okay, so that's the 84,000. Okay, does that help, John?
Yep.
Okay, so so the question that's presented to John and the team is they're expecting a $1,000,000 windfall for this in say 20 and 24. And what should we do with those proceeds? Okay, and when I'm looking at this in this scenario, 100,000 of the current of the 400,000 is say maybe some feed bills, it's a little bit maybe at the end of the year accrued interest, but there's $300,000 worth of 3/4 of that number is actually line of credit dollars, and it's that rate is up there at 8%. That's the rate that I used in the process. Okay, so but what the question is, what are we going to do with this $1,000,000? How, what debt are we going to pay off on that? So I mean, there's different scenarios that we can go through. but the bank has shared with us that we can have the same term on our long-term debt, but we would probably have to reprice it at something different than the 5.5 that is it currently at. So we're going to have a 2% bump in that long-term debt rate. So that could be a something to change for us to think about. But one of the things that we're doing here is do we how I mean that's paying off all of the operating in the process. Um, um, and we're we'd have an increase in working capital. But what we find in that particular scenario is that I mean, in that particular case, um, we're still we're still losing some money, okay, in the process, okay. And so what you're seeing is um, our line of credit interest, went out of, is now gone, but our long-term interest um, changed, 30,000. So that's the $54,000 change in our $54,500 change in our profit and loss. But it didn't really change. It didn't really change much with that windfall. So the question is, what is the other possibilities that we need to think about in this particular situation?
Hang on, Walter, before we go on to that, what you're saying is you've injected $1 million into this business and not much has changed. Is that correct?
That is correct. I mean, our debt coverage didn't even get to 1.
Okay.
Okay. So,
Just
and
injected it and increased what you were already doing with it.
well, I mean, what I did is, I mean, we put $1 million in. We paid off our line of credit, and we put 700,000 on the long-term debt. That's
Yep.
that's what
Okay,
we did
sorry.
with them.
Yeah.
Okay. Yeah.
Yep.
So, I mean, that's in this windfall adjustment account. Okay.
And
So
the main reason the cash flow doesn't change at that point is because we've reduced the long-term liability, but we have not made it go away.
correct.
Yeah.
Right.
Okay.
Right.
All right.
Yeah.
So
Okay.
you've received a gift check for $1 million in the mail, and you're still sort of sucking the tailpipe here. So that's great.
Yep. Yeah.
Like,
Uncle Warren sent that to you.
yeah.
Okay.
How come the equity in the windfall adjustment column is negative now? A negative $1 million there.
Well, I'm that's an accountant thing. Okay.
Negative is
I
positive.
Yeah, because equity went up in the process. Okay. All right. Okay, because see the equity here, I mean, it's just it's accountant debit and credit. Okay.
Okay, okay. Yeah.
All right. All right. So, but that's a good question. Okay, with what's going on here, when you look at the 1,000,004, I mean, that's the new equity. If you take the 440 that is on John's QBO QuickBooks Online, and you put 1 million in there, okay, you should be at 1,440,500, right?
It does, in fact, the equity does in fact go up.
Right. But because we had the operating loss, it didn't change. It did. I mean, it really went backwards. It went back. It went down. Okay. All right. I mean, we didn't gain any additional income. I mean, and here's the pro forma income statement that we're looking at for 2000. I mean, really, the only thing that changed was the interest. And so what you see is you've got a working capital change of $266,000, but there's but really, I mean, it was really a net of 300, the $1 million windfall that we added to our equity, and we paid 700. The 300 is actually, that's something that, is the line of credit. So there's 34,000 that we really went backwards on. Does that make sense, John?
Yep.
Okay.
Does that make sense
that's,
to the rest of you?
pardon? Yeah.
Does that make sense to the rest of you? Need a few comments here to make sure we're all right.
Yeah. And so and that's what I'm getting at is here, well, it's roughly 33, 274. Our current, our current assets. I mean, it's the operating, interest, or we've got the operating loss plus, the principal that we would have on the debt after we refinanced it. So that's the 33,000, that's this piece right here. So we added $1 million to our income, or to our equity, not our income. We had $1 million, and then we had a $5,000 equity. So there's still something that's not quite right here on this particular operation. So
So just to wrap my head around it, and maybe this is what John's looking for as far as a comment. We basically made our business look a little healthier on the balance sheet because there's more equity in it, but
Right.
we're still not profitable. We're just bleeding a little slower, right?
That's
But we
correct.
haven't made any adjustments to how we operate to stop the bleeding or go the other way.
That's right. I mean, our debt to asset now is now 49%. I mean, that's good. Okay. All right. But what's occurring is, we went backwards, the 33,000. Okay. And when you look at that 33,000, it's gonna eat into this, working capital over time if we don't go and change something. Okay. And I mean, John and I have done this piece before. Is our even here? I mean, our return on assets is, under the new scenario. I mean, it didn't change much, 1.36%, but, the interest that we're paying is 30,000. And so, it's the we it's there's no positive impact on our income statement, with, how we've run this, refinancing. Is this making sense, John?
It does to me, but
Okay.
but let's make sure we're good.
Right.
Daniel, are you all right? I'll call
I
some
think
people
so.
out.
Yeah.
Okay.
Yeah.
Heidi, are you hanging with us? Maybe Heidi's multitasking.
It's like
Okay.
in this scenario, it just went to pay down debt. That's all it went
That's
to.
really all that
Okay.
really happened. Yeah, really. I mean, you paid down the debt. So what?
George, does this make sense to you? I know you're in the car. Okay, good.
Yeah, I'm good too, John. Sorry, I couldn't find the
Awesome.
mute button.
That's all right.
That's okay. All right. Yeah. Thank you, Heidi, for weighing in. Okay. So, I mean, what the point of this is that there's still some moving targets that we have to think about in the rest of the income statement. I mean, it looks like there's still some deadwood we need to think about. Does that seem positive, or not positive, but does that seem proper, John?
Yep.
Okay. So, I mean, we looked at our QuickBooks Online and looked at our, our overheads, and they seem pretty firm, in the process. But it looked like that our directs could be a problem. I mean, that seems to be, an issue in this particular operation. Okay. So would that seem, any comments on that, from the team?
No, other than that is where we're often taught to start looking first,
Right.
which is not always a bad thing, but it's something we want to be a little careful of.
Right. Correct.
We want to make sure we're dealing with those in context.
Right. Right. So, I mean, what would happen if those went to 55? Let's see what happens. So, that's a major change. But what we're seeing though is our return on assets is still only 5.2. I mean, I've got kind of the numbers that we're watching, a 5.18%. So, that's something, I mean, it's positive now, but have we got it where we need to be? Another piece is, we're past the FSA threshold, in the process, but we're still not at 1.5. So we need to also keep that whole piece in mind. We're starting to see that, debt is, adding to our finances, in the finances and economics of our operation. Now, we've got 38,000 as a return on our assets with a $30,000 interest there. So we're making $8,600 on the bank's money in the process. So it's going the right way. But when we look at the targets, 5.2 is, there's not, we're not, and that's a little low on the rate of return that we'd be like to see in our business. What would you like to see there? Any of the team members want to make a comment?
I had to look away for a moment, but basically we used that $1 million to somehow lower our direct cost to the 55% range. That's how we changed everything on that pro forma side.
Well, the $1 million didn't really, I mean, the $1 million actually went to, uh, yeah, the $1 million actually went to the bank, so it didn't go to anything specific on the directs. Okay. That's a good question. Yeah. Yeah. All right. But what's going on that particular process is that we looked at, there were some things that could be changed in the process. And so the 55 is, percent seemed to be, when we went through and did a budget for 24, that's where we came in. We thought we could come in at that 600,000 or whatever, but that's still not, I mean, it's increased our net income 109,500, but it's still not quite where we would like to see it. So it just seems that the gross margin is pushing 45%. Is there something else that we need to be thinking about in that piece? So is that, John, does that seem something you want to you have any comments on that?
No, I think let's keep going. This is a place over and over again where we see changing the gross margin percentage is a big lever that because that gives us more money to do all of the rest of the stuff we need to do in the business.
Right.
And surprisingly small changes there can have pretty outsized impacts. And so that's why it is a place where we often have a pretty good degree of focus. Depending on the type of our business, though, we have different expectations.
Right.
For what that number is. And those range from, I don't really like to go below 40, although numbers, or below 50, excuse me, although numbers in the 40s can work. And if we're in a really sort of higher overhead, lower direct cost business, then we want that number to be up in the 70s.
Right. Right. Can we split the difference at 60?
That's great. Yeah. So assume it's a mixed business where we have an intensive feeding operation and a grazing operation together.
Right. Whoops. Then it's a whole different scenario. And so, well, I mean, if we want, let's, maybe that's too much, but there we go. Okay. So now, I mean, we've really worked, we've really had a hard conversation, as we've planned this out, and we've dropped the directs from 60 to 45, and now the rate of return is, I mean, we've got a 17% margin here, and after interest we're 14 and a half. That's all good. And so our return on equity is 15%. Now, the other members of our EL will maybe want to make a $50,000 investment in, I call this some ranch, in the process. So, but what occurred here is, when you go through this, we had 160,000. Then we had $300,000 increase in our working capital, and then the long-term debt principal was at that it was 28. So our working capital is now up 431,000 in the process. But let's go and look at this. Okay. We've got it now at a 3.26% or 3.6. We're covering that principal payment 3.3%. That's this piece right here. John and Jordan and Daniel and the team, that's strong. That's very strong in the process. So, I mean, our pillow talk that we have each night, I think the goal is that too strong? So one way to do that would be to go and go back to the bank and say, okay, what if? I mean, we're pretty much locked in on the rate, but what if we did? Let's change that term to, I mean, we're up here. Let's remember this. We're at 3.26. I mean, the key numbers that we're trying to get you to think about is this debt coverage ratio. And so let's go and change it to 5 and see what happens. We're right at the 2. The 2 in the process. Our working capital is up. Well, I mean, we've got over a $390,000 increase in our working capital in the process. We made 160,000 from our operations. We put the 300 in. And but then also we paid down some principal too. we're things are working a lot better. And then what you're seeing here is the impact of, I mean, sometimes we think that paying this debt off, I mean, this is the balance sheet right here. Okay. But we think paying that off is going to be what saves our bacon. We still have to think about what's in that P&L and that income statement, in the process. So that's just I mean, we had uh, the 160,000 net income. The current assets went up by the 91, and the long-term debt, we paid the 68,000 68,000 on that debt. So in the process, and see the amortization, that's the amortization schedule here, and it's at 5. So in 5 years we've got we're going to be out of debt in the process. So that I mean, we can I think the takeaways that I think we need to think about is in this process is what's that debt servicing ratio going to be after we bring this windfall in. And there's, I mean, one of the deals is one of the processes that we went through. We paid off the high debt first, but then another part of that, do we want to go naked on not having an operating debt? And so I mean, in the process, you probably always want to have a little bit of operating as a push there. So I can change that so that let's just say I'm gonna try to have $100,000 operating, because there's $100,000 of other accounts payable in the process, but it's still a very we're still at our debt coverage is 2.5. That's still real strong. Our working capital went up $300,000, and our net income is 100 and the 159.5, and we're still 15% on the return on equity. So because I mean, having a line of credit out there can be a benefit in case something pops up that we don't want to have to delve into, in our current assets. And it's also, I mean, this is probably, it could be somewhat of like, depending on the context of the business, it could be, you're using it all the time, or, you've got this particular situation, you've got 712,000 in current assets and $200,000 worth of current liabilities. So that's a very, very strong current position. So that's the 512,000 that we have right here. Another piece of this is we have the working capital is running about 2.3 months in this particular situation. That's probably not quite as strong as we would like to see it, but that's going to be built by the you're going to be, as you kind of go through time, you're going to be increasing that about $100,000 a year, which is this number. That's that number there. So that's going to probably get stronger as we move through time. I think you like to see that pushing 3 and 4 months, right, John? Still there, John?
Sorry, I'm muted. Yes, absolutely 3 or 4 months, and depending on the type of business, sometimes longer. So
Right,
3 or
right,
4 months assumes you have some reasonably regular cash flow.
right. Yeah, like a dairy is an example, which is, you
Right.
guys don't do any
Right.
dairies, but
We
dairies.
do. We have 2 dairies. Come on.
Oh, okay, all right, okay,
We have
sorry.
got a great regenerative dairy in North Dakota as an example. So
Whoa, okay, all right.
yeah, kind of cool.
Yeah,
But yeah, feedlot, custom grazing, any of those things, or if you have a component of those, that obviously helps and makes that need a little on the lower side. If you're a once a year, turnover cow calf type operation, then we probably need a little more to be
right.
comfortable.
Yeah, and so what I mean, what we're coming back to is what's our context?
Yep.
Yeah. So, but I mean,
Context and personality. I think, you mentioned the pillow talk thing. My wife and I sometimes disagree on our debt tolerance, and sometimes it is something that we need to talk about and come to terms with in our business when we have a partner of some kind or another.
right, right. So, I just, I mean, we really need to think through the decisions that we're involved in. I mean, um, John and I had one that we were working on earlier, and I mean, this one actually has some conservation easement plus some carbon in it also. So, I mean, the piece that you really got to think about is, um, what are we going to do with, well, there was a conservation easement carbon, and then also some CSP that they were part way through the contract on. And those all, I mean, that impacts, all of what, we're thinking about when we try this, when we look at these plans. And there's a piece of it. I mean, I think that, we have to sometimes, though, I think the current ratio or the working capital and the coverage that we're talking about, I think those are things that I think we when we have the conversation about those, we're, I think, getting prepared for things that impact our business, because I think there sometimes we don't know what those are, and the banker sometimes is doing these behind the scenes, and he's not telling you, why you need to be doing that. And I think that's one of the things that John and his team are so good. I mean, they're in the process of telling you about why that is so key, at looking at these, because I think if you have it helps to minimize the fear factor.
I have a question about this example. Are we assuming there's no room for expansion and that's why we spent the million on debt service versus spending a portion on debt service and then trying to get that debt coverage number right there back down to 2 by spending the rest on like more working capital or expanding or increasing the efficiency of the business?
I did not go there, but I mean that is a possibility. That was not. That was just. I wanted to make a. That's a good question, but I just wanted to get these basics out, because some of that $1 million could be used for expansion. I mean, I kept the revenue the same here just for the sake of argument for what I'm doing, but no, that's the question that I think, and when you guys are in your executive links, that you need to ask that peer that you're chatting with. Good question. Because when you go back here, when you look at what was, I mean, if you go say if you look at these numbers right here, I mean, the question would be, which if you know, Dallas and Dave Pratt, they've always had, will you make that $50,000 investment in this business? Well, if we've got a negative 12% ROE, I don't think we would probably think about that. But if we can actually get them to think about doing some transformation, and we go to the 15, that's a different mindset. That's a different, I don't want to say it's a game, but it's a different scenario.
And Taylor, that relates to the question you asked a couple of minutes ago, which is, you know, when we talk about, you know, allocation of capital, many of us in our world have a gut instinct of, oh, we just need to pay down debt, right? What would be better than to be able to put $1 million towards the mortgage? And what we see over and over again is, while that can be a good decision,
That's right.
it isn't universally a good decision. And there are places where that actually, you know, literally just makes $1 million disappear and has no positive effect.
Yeah.
Right.
John and
Wait,
Walter, would it
go
be
ahead.
fair to say in this situation, what you've done here with this windfall, that you have built a business that is more capable of expansion in the future, rather than just
Business you'd be interested in expanding, yes.
That's
right,
correct.
Right.
Yeah. I want to be aligned. I mean, if I'm sitting on that executive link board, I want to be aligned with helping them to get to move it to whatever the next level is.
Yep,
I'll
absolutely.
I'll
Go ahead.
add something too. So what I'm hearing you say, Walter, too, is profit trumps everything, right? Because like, even if you put $1 million down on debt, you're still going to just bleed slower over time, right?
That's exactly what happened here.
So,
Right.
so what I've noticed was people get these windfalls in there too, and John just said it. Taylor brought up a great point. But our default is always to pay down debt. Well, this person on this ranch could have taken that $1 million and put it in a 5% CD and paid for its losses and kept continuing on, right? Happy as could be.
That's
So
correct.
that's the other way of thinking about it. But I've also told people that come into these too, cash slips through our fingers, right? So you've got 85,000 in family living, plus if they go buy a few more things, there's only 6 or 8 years of a windfall cash
Right.
in there. And $1 million sounds like a lot to all of us, but we'd all be amazed at how fast we could spend it. And I've seen people, it made me think too, a windfall could just be a debt restructure. And so when, you know, real estate loans were going for 3 and 4%, we had a lot of people restructure loans, which I thought was a good idea. But then if they have that annual payment and it's not for 11 more months, then every time they have cash in their pocket, they buy something and they trickle themselves into a cash flow crunch eventually again. So just mindset and be careful with cash.
Right. Right. Yeah. Yeah.
One of the reasons Bud insisted that you go back and buy back in the same market is because cash tended to disappear.
Right.
Yeah, that's a very good observation. Yep, very good observation. So, but I mean, this particular scenario, it went from $59,000 negative to $219,000 it went to $219,000 change, but 165. I mean, part of it, I mean, the debt pay down added 54,000 to the process, but 165 of it came from, doing the deeper dive into the business.
Cool. What else? What other questions do we have?
I mean, one of the, I want to appraise the team. Is that okay, John?
You can, you can do that.
Well, I mean, when we had the conversation, earlier, about, there were kind of three moving parts. I mean, it was a different conversation when the information was there. I mean, I know I've got a whatever, I'm gonna say a 30,000 foot P&L here, but it's a different conversation when we have what you got, what the Ranch Right team is doing. So I mean, that is, then you can make these decisions about how you create this $200,000 extra income so that the family can stay in the game.
Yep, totally agree.
So, but I just wanted to, that's just, God bless what you do, each month, with your clients. There's this guy in Illinois that's a member of the Ranch Right fan club.
Always been a raving fan. Well, I appreciate that, and obviously you taught us, so that's made a big difference.
All right.
John and Walter, one thought that I had is this wouldn't even necessarily have to be a windfall. I mean, you could create your own windfall in restructuring how your business
Yes.
operates. Could you
That's
not?
correct. That's correct.
Yes.
Right. 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 But the piece of it is, well, I agree. That's a good comment. But you also have to look at there's a combination here of the debt to asset. I mean, this was getting up there where when you're 75%, there's a
Hard to
piece.
dig out of.
Yeah, yeah. You're just going to keep digging.
John, you have a question in the chat too. I don't know if you saw it or not.
I did not. Hmm. Okay, Jared, do you, if you're on here and you want to explain a little, that'd be good. ROE is different than ROA, correct? So ROE is, remember, return on equity versus return on assets.
Right.
I agree with the 9 to 12% ROA. No intelligent thoughts on ROE, not knowing exactly what it is. Perfect. Okay, so generally, Jared, what we expect is if there is borrowed money that is against assets that are contributing to the return, then that generally increases the ROE. So we, equity
Or ROA, it increases the ROA. And so, well, let me just go there just a second, John.
Sure.
What we're doing is that when you go through this whole process, because the ROE is greater than the ROA in this particular space. I mean, you can actually quantify it. Okay. And so, that there's a 1.5% change. There's a 1.5%. See, we're roughly at an ROA of about 10. And the debt that we're using, et cetera, and making money on that debt, and see, that's this piece right here. That's bumping up that return to, say, the 15.63.
So that kind of answered your question, Jared.
Not really.
Okay.
So when we talk about equity, it's similar to depreciation.
No, depreciation.
No, equity.
Well,
Equity is your money that's in the business.
Right. As far as the confusion,
I see. Oh, I
the
got you.
confusing
Okay.
term.
Yes, I got
So
you.
I've got equity in the business. I've got an equity position based on the loan. I've got $1 million worth of stuff. I've got 50% of leverage, so it's 50% equity on it.
Right, correct. Right.
So the return on equity
would be double.
I didn't quite know what that equity meant. If I'm 25% equity owner of the company, and so this is the return on that percentage.
Right, that's
what
correct.
that is.
Right.
So if I was 25% owner of this company, I would expect that I would, in this middle of the sheet there, I would be getting a 15.63%
That's right.
return on whatever
Right.
value that is. Is that correct, Walter?
That's correct.
Okay.
Yeah. Yeah. So I mean, what we've stated in the past here is for, I mean, we can go and argue about what mutual funds are, but I mean, I think John and the team, if we need to probably be thinking about that 15% as a rate of return on our equity, because there's probably a 5%. Uh, I mean, we need to be making that for the risks that we're taking.
Yeah. And you can make that in the 8 to 10 range too, if you want. That again is a personal choice.
Right. Correct. Right. Yeah. That's your context.
Yep.
Good question.
What else, guys? What other questions do you have?
I've got one for you, John and Walter. And maybe within the context of this training, it doesn't really fit, but something from my situation is in the case of a windfall, I think there'll be tax implications that must be considered.
Right. Correct.
So if in your first case, if you put all that $1 million into paying down debt, good, bad, or otherwise, and then you end up with a $250,000 tax bill, essentially you've shot yourself in the foot. Is that correct?
Made it even
Well,
worse.
yeah, I mean, the taxes are going to have an impact, because if you got 25% deal, you only got 750 to play with.
Right.
Right.
But to me, it's something to be considered.
Oh yeah.
That you may
100%.
have a tax bill to pay, so you may want to put some of that, tuck it away to
Yep.
take care of
Yes.
that.
Yes.
And the
yeah,
scenario
yeah.
you've run here, Walter, is kind of net of taxes, right?
That's correct.
Now, this is another place where Taylor's earlier question about how do you allocate that becomes even more critical, because there are ways to allocate that can provide tax benefits that can additionally, sort of shelter the money that you also use to pay down debt. You can do those things simultaneously very,
Right.
very nicely.
All right. So
Jordan, you want to add to that?
No, I think you guys got it. Once again, big picture.
Yeah. Good. What else, Walter?
I think that's all I've got today. It's a pleasure. I mean, the takeaway that I think that we want to think about is there's some ratios that are part of what the Ranch Right team does, and then the big one that we keep coming back to is this debt coverage ratio. Which what let me just refresh, but what we're doing here is it's really the earnings before interest, okay, compared to the term debt payment. So I mean, that's what we're trying to do. And John and the team are, when they tell you need to be in that 1.5 and north of 1.5, they're not blowing smoke at you in the process. So anyway, that's just make sure that that you have an understanding of that. And let me just kind of if we take the 190 and you divide it by the 74, whoops. Yeah, see, that's the 256.
You're in great
So,
shape there.
yep. Okay.
Yep.
So I mean, that's
Okay, wait, let me interrupt here a minute. We got another question that I want to make sure we get to, because this is an important and exciting one. Sam asks, what are the best returns we're seeing out there? And he was talking ROA. And would you think about land debt differently? And I would definitely say we think about land debt, or land, just everything about land, entirely differently.
Right.
But Walter, what are some of the big numbers you see for ROA? Because I think we see some numbers here that honestly blow people's minds.
Well, I mean, I think I mean, it all kind of depends on
Oh, it does.
on your context, but I mean, you're going to see, I mean, land drags it down. So
Yes.
and I think I mean, that's one of the reasons that I want to make a comment about is that piece about segregating the land out when you do the analysis. I mean, the land can mess with your mind. I mean, you got to make that land payment. I agree with that.
Yep.
But when you're trying to look at the rate of return, you need to be looking probably at the operating assets. And so I mean, I'm in the camp if you're getting on the ROA side of it, if you're pushing, I mean, in this particular example here, we're pushing 9 or pushing 10. That's a nice rate of return on an ROA. So I mean, and some are going to be under that and some are going to be over that, but you have to think about, the context of how you get there, because I mean, what it really is it's these three numbers, or those two numbers right there. That's when you take the turnover times the profit margin, that's how you get it.
Yep. And I think on ROA, when we talk land, the higher end of that range would be approaching 5, 6, 7 even percent. Is that fair?
It can be, yeah.
Yeah.
I mean,
I don't know.
yeah.
I don't know that I've ever, or I should say, I don't know if I've recently seen 10, but I'm sure it's possible.
Right.
Okay. So this is for a ranch business. You typically think of 5 to 6% is on the high end of
Of the land return.
Right.
Okay.
Okay, so no, that's not a ranch business. That's a land business. On the
Right.
operating end, we see numbers over 50%.
Right.
Yeah. Okay.
And so that's the part where most people assume the operating percent would be lucky to achieve what the land business returns, right? 2 to 5% in a ranch operations business is considered, good general industry wide. But we see 50 and 50% and better on that. And in a few cases, we see numbers approaching that are, maintained over a 10-year period. So
Yeah. And it's just one part of the whole, right? I mean, you
correct. That's exactly right. Sam, does that answer your question?
Yeah, thank you. And I guess
I
what I
thought
was thinking about is, if at some point you had a business that was getting 30 to 50% returns, and you had too much money tied up in land, right? Like, if you were sort of strictly chasing returns, I guess, but
if you can run a business consistently in that 30 to 50% range, that's a business you want to continue owning.
Right.
Just keep doing it. And use the proceeds to buy land, which will return less, but that's okay.
It depends on the goal.
That's exactly right. Derek Jackson is asking, ROA and operating companies will vary based on the type of business. Correct. Custom grazing versus feedlot. Yeah, there is a huge amount of variation in that.
Right.
Over and over again, we see the highest returns in ownership. But there are custom and sort of service type situations that can have fairly high returns, but rarely as high as the highest owned enterprises. All right. Can we take a quick pivot before we finish here, Walter?
Yeah, go ahead.
All right. I've got a spreadsheet I'd like to share, if that's all right.
Okay.
And I want to give this to you as a thought question. Now, I want to assume now that our business is functioning correctly. We have a business that is performing, and we are now going to figure out what to do with windfall money, and we are going to do it on debt. The thing I want to emphasize here is that there are a lot of potential outcomes just by looking at how debt works. If Walter's Sum Ranch here has 9 different loans,
Right.
Okay, each with different interest rates and different principal amounts. And I've made these super simple, so don't read a lot into this. Each of those loans has an annual payment.
Right.
Okay. When I look at a business and the impact of new money, one of the main, assuming the business is, sort of functionally reasonable underneath, then cash flow is the biggest place I'm going to look to have a future impact. What I'm going to propose to you is if you had a $50,000 windfall and you were going to use it on debt, where would you be best to put the money? So for example, and we're going to go through a few of these. So for example, if I have a $50,000 windfall and I put it on this $500,000 debt, it has zero impact on my cash flow. Does that make sense? Jordan, you look very concerned.
No, I was actually looking at the different loans.
Right.
Okay.
Because
Don't read too much into those.
well, the last one has a 20% interest rate, so their loan shark got that one, but that's okay.
For $10 million. Yeah, it's a pretty big
Yeah,
payment.
yeah.
Right. Okay, but again, what I want to focus on here is if I have $50,000 to plug into this and my goal is to increase cash flow, I have a couple of choices, right? I could put it on this note, or I could put it on this note. And the reason that would work is because it would literally make one of those payments go away.
Correct.
Okay, interest rate is important, term is important. Okay, does that make sense to everybody? Grant,
Right.
does that make sense to you?
Right.
Yeah, on a cash flow basis, yes, I
Correct.
agree with that.
All right, so there are a couple of different ways I could allocate my 50,000 in this way to have a positive impact. One note gives me a $12,000 impact. One note gives me a almost $17,000 impact.
Right.
Okay. When
Right.
we choose between loans, in my mind, this bottom line cash flow impact is the most important thing you can look at. Okay.
And that's back to the debt servicing ratio, really.
Correct. Don't worry about the interest rate. I don't worry about the term. I look only at the cash flow impact. Now, obviously, those two things interact. The balance of the loan matters, blah, blah, blah. But don't get caught up on those things. Those are like red herrings. They will trap you if you watch them too much. If I had $100,000 windfall, what's my best option? And this is a quiz. Because I have multiple options, right? I could pay off two $50,000 loans. I could pay off one $100,000 loan. I could pay off 1/5 of a $500,000 loan. Correct, Tyson. This is very similar, and Kevin, this is very similar to Ramsey's debt snowball. The only difference is Dave always starts with the smallest and works up to the largest. He's worried about your mental health in this approach. I am worried about what causes the biggest cash flow reduction, which
Right.
means I don't always start with the smallest.
Correct.
Which goes hand in hand with mental health, if you want to go there.
Well, we can talk about that, yes. But he's in a behavioral approach, right? And again, I thoroughly appreciate what he does. I think what he does is really good. Again, we're going to look at cash flow as a positive mental health factor being the most important. Anybody got an answer? Jordan, you can't answer.
I'm going to
Ken?
say
Go
three
ahead.
and what's the other one? 6 or 6.
Okay, so good. Anybody else? Anybody want to vote against that? Ricky, you said the same thing. Is that right?
I was thinking 2, but yeah, I can see where he's going with 3 and 6. I agree with that
Okay.
too.
Okay. Anybody got a different guess? We're not going to drag this out too long. Here are the different combinations I could come up with. So you could pay off one $100,000 loan.
Right.
You could pay off a different $100,000 loan, or you could pay off, just like Grant said, two $50,000 loans and get to the 28.
Right.
I promise it doesn't always work out that way. That obviously works out pretty well according to Dave Ramsey's debt snowball. Oh, sorry. So let's go now. We have $1 million windfall. Now we got lots of choices. This becomes a bit of a combinatorics problem. Which ones are you going to pay off? You got $1 million. You could pay off $1 million loan. You could pay off two $500,000 loans. What are you going to do?
1, 2, 3, 5, 6, and then head to Cabo with the rest.
Aha!
Here we go.
Taylor, you're too good at this. You saw the game ahead. You said 1, 2, 3. What else?
I
5,
said
6.
5, 6, but I think my math was off. I thought you had a little extra. I was saying go on
You-
vacation with that. Yeah, plus 200.
Yep.
There you go.
Yeah.
Right.
So this actually produces I spend 800,000 of the 1 million, produces the greatest cash flow impact and leaves you with $200,000 in the bank. So you've just built your working capital by $200,000 and improved your cash flow. Thanks, Catherine and Bruce. Appreciate you guys being here. Does that make sense?
Yep.
So when we go through these things, if debt reduction is part of our plan, to my mind, cash flow is the best part you can focus on because, as Walter mentioned, this all ties back to your future ability to reduce debt further, which all comes from cash.
Right.
So you can play this game all you want. It's a lot of fun. Don't get caught up in interest rates. You do not pay the highest interest rate loan first. It doesn't work the best. Reducing your interest expense, and Walter, you've kind of touched on this earlier, reducing your interest expense is not always the best thing for your business.
Mm-hmm.
We would all love to not pay interest. Like, please don't mistake that, but it is often not the best thing for your business. You don't want to focus on that. Now, if you are going to pay interest on borrowed money, that money damn sure better be doing work for you. Do not borrow money on things that are not doing work. So when we talk,
and that's that part that's over on the right on my spreadsheet. That's
correct.
Yeah, that's priceless.
Yep, I agree. Like if you're going to borrow money, that money better work. Okay, but when we are working our way out of debt, if we're going to do that, then let's first off, when you get new capital, consider if debt is one of the things you should be or want to be doing, and then follow that on with, okay, which debts are the best. Sometimes we also have sort of attachments to or real aversions to individual loan. We may have a loan that we just hate. Don't get overly emotional about it. Try to remember it's cash flow. Okay, that's all I got on that.
Okay.
Walter, thank you very much. I really appreciate it. I am very thankful that all of the rest of you choose to come to these. I just, again, looking through our list of people, as we talked about at the beginning, the age of you is all impressive to me, because generally when I go to a Wyoming stock growers event, everybody's 60 and 70. And when I'm in here, everybody's seems like in their 30s with some 40s and 50s scattered in. So I appreciate, Walter, you being willing to sort of download your decades of experience on this. So that's really what we're trying to do in these webinars. And we will share Walter's spreadsheet on our website, and in conjunction with sharing this video. So you're welcome to look through those and play around with it.
Yeah, and call me if you have questions.
Awesome. Great.
Now, Grant Harder, do you require tutoring when I go to Kansas in a couple weeks?
I do.
Okay, I thought I probably would have
The
to
answer
do
to that
that.
is always yes.
Always.
Awesome.
Yeah,
Good.
be great. Be great.
Cool. Thank you, guys.
Bye.
Thanks, Walter.
Bye.
Thanks, Walter. See ya.
Bye. Thank you, guys.